Stocks pull back after a strong open led by IT and realty, while autos and utilities show some strength. Mid-caps fare better.
Passenger vehicle makers perk up as signs of fight back emerge. M&M's Anish Shah says the SUV major is looking to double capacity, while analysts say Maruti making a strong comeback with new launches.
PVR skids after prominent investors sell a collective 7.7% stake, and GR Infra sulks after promoters launch an open offer for sale for up to 6.8% stake at a significant discount. But Sundaram Fasteners perks up after a domestic fund picks up stake from promoters on Wednesday.
Mid-cap stocks outperform with several cues driving counters. Home First Finance perks up on reports of a likely strategic deal, while Aditya Birla Capital gains after CCI clears investment in its health insurance arm. Optimistic order outlook also drives up KEC.
Hello and welcome to Halftime Report. I'm Ekta Batra. With me is Mangalam Malu. Well, it's turning out to be a session where we are seeing a little bit of trepidation now coming into the markets. We did see an FII net sell figure yesterday. So we have the Nifty, which is down around 100 odd points at this point in time. We have the Bank Nifty, which is correcting around 0.4%. So maybe there is now some concern on the fringe, which is coming through with regards to what the FOMC could do when they meet next week, where the dollar index could eventually move to, and what the impact could be for the Indian markets as well. So the mid-cap index just about holding its head above the water, higher by around 0.14%. A lot of stocks in focus, Mangalam. IT seems to now be seeing a little bit of a downtick again. So we have Infosys, which is now down around 2.8%. Hindalco not doing too great either at this point. Hindalco from the metal space is your top loser on the Nifty.
Yes, we do have a lot of stocks in focus. In fact, the ones which are auto and auto related are the ones which are buzzing. In fact, just the last few minutes, we saw a big spike on MRF. A lot of these tire players, actually, CH2 has moved to the high point of trade. The street is betting on domestic consumption recovery, which includes the autos, etc., and auto ancillaries, as against export-facing sectors, which is why we're seeing some weakness in IT, etc. But be that as it may, we do have a lot of stocks which are buzzing around, and one of them is CCL Products. On our radar after a big move that we've seen over the last few trading sessions on that counter. Yes, it is slightly muted in today's trading session, but as you can see from the chart as well, dips are being bought. The company has significant capex lined up for the future, and it also raised its guidance after the first quarter from 15 to 20% to 20 to 25% for its revenue. What are the triggers going ahead, and how's business like now? We do have Chala Srisant, who's the managing director of the company, joining in. Thanks a lot, Chala, for joining in. You know, you've always said that commodity prices don't affect you as much. What the triggers for the company going forward are the significant capex that you have both in India as well as Vietnam across verticals like spray-dried as well as freeze-dried, and the India business as a whole, the Continental Coffee branded business that you have. With all this capex, can you give us a sense of what comes on stream by when, and what is the kind of revenue pipeline that you have for, say, the next couple of years once the entire capex piece is over?
Last year, we've come online with 3,500 ton capacity in Vietnam. And this year, we are enhancing the capacity to 30,000 tons in Vietnam. By next year end, we are looking at adding another 16,000 tons in India. So that will make the overall capacity about 71,000 tons by FY24.
Okay, all right. So that's on capacity utilization. But you seem to be quite optimistic about, demand, considering that you've raised your guidance to around 20 to 25%. So give us a sense in terms of where exactly are these demand drivers coming through, and do you expect it probably sustaining?
Yes, so we have been expanding our presence across the world for the last 25 years. We've built relations in various countries with multiple customers, and we are seeing a lot of volume growth with our existing customers itself, with our existing brands that we are already supplying to. And we're also adding some new customers every year. The last couple of years have been challenging, but thanks to the partners and the relationships that we have built, we are quite confident that we can keep increasing volumes going forward as well.
Right. Chala, one thing that the street would want to understand is that with this increased capacity by FY24, at what point does CapEx take a pause for you? Because it's been the last few years since, you've increased your CapEx allocation for a very long time. And as a result of which, your ROCEs have, or return on capital, has taken a bit of a hit. At the same time, we've seen your free cash flow turn negative to the firm because of the CapEx that you've incurred. So at what point do ROCs begin to spike? At what point does the firm actually have some free cash flow?
So to be very frank, as a company philosophy also, we wanted to utilize our funds in a much more efficient manner. We are not having extra free cash flows at our end also kind of symbolizes that we're not putting our money to work very efficiently. So we've been planning our expansion also in such a manner that our dividend policy will not change with the 30% dividend year on year. We are doing a combination of debt plus equity in a manner so that we have optimal utilization of our cash flows.
Okay. I was just going through your conference call transcript where you have indicated that your volume growth was around 25%. There was pricing growth of double digits the quarter gone by as well. Are you in a position to probably hike prices further? Do you see enough demand irrespective of what's taking place in the commodity cycle for you to possibly pass it on and see pricing growth? Give us a guidance on both of these parameters.
Yeah, so our business model also is such that whatever is the coffee prices, frankly, doesn't make a difference for us because we work in a cost-plus model. That's the model that we've been following for more than 25 years. And our growth comes because of the volumes and the new customers that we are adding all the time.
Right. As far as the domestic business is concerned, Continental Coffee, that is, you've scaled that up from, I remember you talking about 150 crores and then went all the way up to 200 crores in FY22. You've guided for 35 to 40% this year as well. What is your long-term prognosis of how big Continental Coffee itself can be in India? What's the kind of investment that requires in branding, distribution, etc.? And at what level will it start to be, big accretion? It will be accretive to your earnings going forward.
So to be very frank, at this particular point in time, the guidance given to the team is to focus only on the volume growth and to build a stronger brand that is likely to sustain in the long run. We are very frankly going up against big MNCs within India, and it's not that easy to establish a brand anywhere in the world. So we have taken a conscious call that we want to build a very sustainable brand, which is what we are doing. Our core business itself is currently growing at a very healthy pace. So there's no real dependence for us on bottom line contribution from the domestic business at this point in time. We've already broken even last year itself, and going forward also, we are quite confident that the same level of growth that we want to sustain, we will have to invest a little bit more to grow faster, which is what we are doing right now.
I wanted to know actually as a follow-up, how much are you looking to invest in this? And when you say you want to grow in terms of volumes, what is the size you're looking at? Because not only are large MNC players in the coffee space, we do have a lot of these D2C players coming in and eating into the lower end of, by lower end, I mean one end of the market as well. So in that, what is the money that you've earmarked or have planned to, invest in this?
So over the last couple of years, we have invested almost about 75 crores over the last 5 years. And going forward also, what we are doing is whatever is the revenue generation that is taking place, we are planning on reinvesting that additional profits into growing the business. That is our objective. So around, you can take an average of maybe 15-20 crores year on year is what we are planning on reinvesting in the business. And even after this reinvestment, we will be still at a break-even stage.
Okay, well, we're definitely discussing too one of the favorite things that I consume, which is coffee. But the other thing which I'm really interested to know about is your plant-based protein. You just about launched it. It's a test-based, launch in 3 cities. How is it doing?
So the response has been really good right now. We've done a lot of sampling activities. People are quite surprised. They're saying that as a product, they're not able to distinguish between meat and this. So it's a lot of positive response that we have gotten as of now. There's a lot more awareness building that needs to be done. As time goes, as this category grows, while more awareness comes, we are confident that the volumes also will come.
All right, take that point, Chala. Always a pleasure speaking with you. And we always come out, more knowledgeable about the coffee sector after having spoken to you. So maybe it's literally coffee for our knowledge itself. That's about CCL products. Over the last, today, of course, it's flat. But if you just take a look at it over the last few months, we've seen a big rally on that counter. But let's move on to a CNBC-TV18 exclusive. Sources tell us that the LIC company is actually considering to start its own depository for insurance DMAT or dematerialization. Yash, you had spoken about DMAT earlier, insurance DMAT, and now LIC plans to start its own DMAT business or DMAT arm. That should be a positive for them.
Well, that's correct, Mangalam. I mean, the last week we've been talking about what dematerialization is, what does it do to depositories in terms of additional revenue. The latest that we've been given to understand from our sources is that considering this opportunity which is coming for insurance companies, for depositories, the largest life insurance company, that is Life Insurance Corporation of India or LIC, is looking at starting its own captive depository. Now, this is essentially for the purpose of dematerialization of insurance policies, and there are deadlines or timelines which have been given by the insurance regulator when it comes to dematerializing insurance policies. The regulators very clearly said so far to companies that after December 2022, that is December of this year, all new policies will have to be issued in DMAT format, and a year after that, that is by December 2023, old existing policies will have to be brought on the DMAT platform. Now, otherwise, in a normal setup, all these life and general insurance companies would have to pay certain costs to depositories like CDSL, NSDL, Carvi, CAMS, to dematerialize the insurance policies. And looking at this very opportunity, the largest life insurance company is looking at starting its own depository. Now, what we've been given to understand is that LIC plans to speak to the regulator, that is IRDAI, very soon on these plans. Just a quick look at the kind of cost that is involved. LIC issues around 2 crore policies each year. There are about, the cost for dematerialization is 50 to 60 rupees. There are 22 crore existing LIC policies in the system. Overall, the money which LIC would have to pay at the current estimated cost would have been 1200 to 1400 crore. That gets saved. That in fact comes into its own subsidiary if this depository actually comes into existence.
Okay, all right. Interesting statistics there, Yash. Thanks very much for joining in. So that's on LIC. We need to take a short break. But before we do that, a quick reminder for our viewers. It's that time of the year again. Money Control Pro's Financial Freedom offer is back with added benefits. Get a Money Control Pro subscription at net zero cost by claiming exciting offers worth 1,500 rupees from our partner brands. Grab the benefits now only on the Money Control app or website.
Welcome back. You're watching us here on Halftime Report. Maruti is the stock which has hit a fresh 52-week high, in fact, a fresh record high on that counter after Bank of America has raised its target on the stock. Sonia stands by to tell us more on that. Sonia.
Well, Maruti has hit a fresh 52-week high today. In fact, that stock has been on a tear. It's up 24% in 2022 already. Brokerages are very bullish on Maruti. BofA Securities or Bank of America Securities has come out with a bullish report this morning where they have raised their target price on Maruti to 10,500 versus 9,500 earlier. They say that Maruti has made a big comeback, especially with a slew of their new launches, and those launches look very promising. A good response to the new Brezza, despite despite the premium pricing is very encouraging, and hence BofA Securities has raised their earnings estimates on Maruti. They say that Maruti is now plugging the gap that it had in the mid and premium SUV segment. They expect a volume growth of 14% compounded over FY22 to 25, and they're also revising their revenue targets upward by about 6 to 8% and their EPS estimates by about 9 to 10%. So Maruti as a stock has given you positive monthly returns for 6 straight months in a row. Definitely bullish momentum over here. Back to you.
Okay, all right, Sonia, thanks very much for that. Not as lucky for PVR in today's trading session. It's under pressure. This is on the back of a large block deal which took place. Nimesh is here with the details on that particular one. Nimesh.
Hi, Tasarab. As you rightly pointed out, PVR is under pressure largely on the back of a large block deal wherein a clutch of private equity investors sold 7.5% stake in the company via block deal. The average price was 1891, which indicated a 2.5% discount to yesterday's closing price. And even then, the stock is under pressure today. In terms of buyers, I understand 80% of the book was subscribed by long-only funds and 20% was bid by some hedge funds as well. Now, within the long-onlys, it was a mix of both FIs and DIs. And I believe one of the domestic mutual fund was an anchor investor in today's block deal. So a good clutch of investors have bought, but the supply overhang seems to be a key reason why the stock is under pressure today. Remember, in PVR, the institutional holding is quite high. So 83% is held between mutual funds, FIs, and private equity investors. And looks like in today's block deal, it's a shift of hands from private equity to some domestic and FI investors. But the stock is under pressure largely because a big block was sold and at a discount. So that's the key reason why the stock is under pressure today.
Take that point, Nimesh. Thanks a lot for that. So that's about PVR. But just keep an eye out on a couple of these cement stocks. This morning, they opened slightly lower after a big rally that we saw yesterday. India Cements, for instance, yesterday was at one point, locked in that 10% upper freeze, at the temporary freeze because it's an F&O stock. And today it opened slightly lower. From the lows, it has seen a recovery of almost 4.5 odd percent. So dips are being bought on these stocks itself. But talking about mid caps and a couple of these other stocks which are in focus, GR Infra is the one which is sulking in trade after promoters have launched an open offer for sale up to 7% stake at a significant discount. On the other hand, we have an optimistic order book coming in for KEC International. Vivek joins in with some more details on both these counters. Vivek.
Well, that's right. So first, let's have a look at GR Infra and what exactly is the development. So the promoters who were earlier holding close to 86.5% stake in the company. Now, SEBI regulations do not allow the promoters to hold such a large stake, and because of that, they have gone ahead and launched an OFS, an offer for sale, to go ahead and reduce or pare their shareholding. Now, what they're doing is this particular OFS, they're looking to pare close to 6.8% stake, with the base size at close to 6%, 5.9 to be precise, and the green shoe option of another 1% of 0.9%. Now, the floor price is what has actually kept this particular stock sulking at 1260 rupees a share, which is almost a discount of a little over 8% to yesterday's closing price. It's mandatory for them to reduce their shareholding to meet the regulatory norms. On the other hand, when you're looking at KEC International, now remember KEC International actually had a bit of an underwhelming Q1 FY23. There was worries about the margin outlook and also worries about a temporary spike as far as the debt levels were concerned. So yesterday during the RPG Group annual investor day, the management actually went ahead and clarified a lot of these concerns to the analyst community. Nomura has come out with a note. Nomura said they addressed the investors' concerns as far as margins and debt were concerned. The company expects very, very strong ordering, and in fact, the order inflow as far as this particular YTD is concerned has come in at close to 6,000 crore, almost achieving 30% of the FY23 guidance. They're targeting an order book of close to 40,000 crore by FY25 and hope to get an order inflow of close to 20,000 crore for FY23. So interesting to see, what exactly happens going forward. Some worries about the Brazilian, operations as well, which the management has assuaged investors would be, ending as far as this particular fiscal is concerned.
Okay, all right, Vivek. Thanks very much for that. In fact, earlier today, we did catch up with the management of KEC, and they did address a lot of these concerns, such as from Brazil as well as margins. Let's listen in to what they had to say.
So as far as Brazil is concerned, all our legacy projects will get over by October or max, let's say 15 November or so. So Q2 and maximum Q3 would be the last quarter where we would see a negative impact from Brazil coming in. So Q4 onwards, I think we have a good book in Brazil on supplies. So it will start turning positive from that. Q2 would remain at a similar level to Q1. Q3 we will start improving, maybe 50, 60 basis points, 70 basis points. It will to depend more on how much we are able to fast track execution of the newer projects other than Brazil. Q4, maybe another 100 basis points. And what we have been generally talking about is from FY24, we should inch back towards our normal double-digit margins.
Okay, so that's KEC, stock up around 2% at this point in time, assuaging concerns. We'll take a break now, but up next, Kush Bora will join in to talk about trading strategies and the technical setup. Stay tuned.
Welcome back. Just keep an eye out on Adani Ports. Now, over the last couple of days, there have been a couple of brokerage notes as well. The management had met the analysts at Jefferies, and this morning we had a note from Citi as well. They've increased their target to 1100 on that counter as well. Jefferies too yesterday had increased their target to over 1,000 rupees on that counter, citing the fact that the company is increasing both organically and inorganically its presence in the port space, and there is a lot of potential for them to grow out there in the verticals that they are operating in. So a big move that we're witnessing out there, the stock at the high point of trade. But we have some more news coming in on the banking pack. Yes Bank may emerge with a near clean balance sheet by the end of this year with the sale of their NPA portfolio, which is currently at an advanced stage. The board committee will meet today to approve this NPA transfer. Ritu Singh joins in with more on the same. Ritu.
That's right. The board's credit committee for Yes Bank is meeting today to approve the 48,000 crore rupee NPA sale to JC Flowers ARC, the pact for which was signed earlier and a Swiss auction was concluded where JC Flowers with its 11,183 crore rupee offer had emerged as the highest bidder. Now with this credit committee approval and the subsequent board note, no other regulatory approvals will be required for this transfer, and we've been given to understand from our sources within the bank that they're targeting to conclude the sale by the end of the third quarter, which is when you could see Yes Bank emerge with a near clear balance sheet. Their gross NPA stood at a little over 13% of the end of June, and this will fall to under 2% as per the management commentary. They're also in the process of seeking RBI's approval to acquire 20% stake in JC Flowers ARC, in which the bank had earlier said it will invest up to 350 crore rupees if the nod indeed is forthcoming. Now, as per the terms of the agreement and the 1585 structure under which the ARC works, JC Flowers will have to shell out about 1,677 crore rupees within 60 days of the final nod coming in. So the process is in advanced stages. Expect the conclusion to happen very soon.
Okay, all right, Ritu. Thanks very much for that. So that's on Yes Bank. We need to talk about the technicals of the market now. Kush Bora joins in to discuss what he's strategizing today. Kush, hi, close towards the end of the week. So what is your strategy both for the Nifty as well as the mid caps, which have been more resilient, you'd have to say, as compared to the frontliners?
Sure. First up, Ekta, thank you for having me on the show. And you're right. There is a lot more action in the broader markets than on the indices. We live in the age of instant gratification, don't we? And bulls certainly got that yesterday. I mean, we didn't stay low for more than an hour, and we saw a very sharp pullback. Now, for the expiry today, 17,800 put and 18,000 call. They have a very strong base. And I think the expiry trade for the day might be over. We might expire around the current levels. But for the month, 18,000 call and put have a very strong base. And if you put the premiums together, then 17,500 and 18,500 zones are something that the markets will watch out for the rest of the month. Now, Bank Nifty is going very strong, both on the account of private and PSU banks. But this is more of a catch-up trade. Nifty made its high a long time ago. Bank Nifty is just getting there. So I'd be a little cautious here. Another word of caution is, on the RSI front. If we look at the Nifty, in fact, even the Bank Nifty today, there's a very clear RSI divergence. This is an indicator of a trend reversal. Now, I don't want to set the cat amongst the pigeons and say that, we would probably be, reversing the trend, but we're waiting for a confirmation. Below 17,700, if the Nifty closes, I would be light on my leveraged positions. Now, there could be a lot of surprises that could come from the Fed or any other part of the globe. So below 17,700 is where I will be light on my leveraged positions. As far as the stocks go, I have two picks. One of them is ABFRL, the other is Cera Sanitary Ware. Now, ABFRL has been going from strength to strength. 300 is a level where the stock had resisted for a very long time. And after that, we've seen a very sharp run up. I expect this momentum to continue. On an immediate basis, the stock could reach levels of 345. And here, if someone enters now, a stop loss would be for 332. Cera Sanitaryware, similarly, we're quite bullish on the entire housing theme, be it housing finance, be it construction, redevelopment, the entire space. So Cera Sanitaryware falls in that space, has been doing very well. We expect the momentum in the stock to continue for about 16,100 target. And here, an immediate stop loss would be 5,700.
All right, take that point. And we do have some more news coming in, and this one comes in on the hospital space. Aster DM has acquired 2% stake in Medcare Hospital LCC for an amount which
51 crores. So I think that's the amount, 51 crores.
51 crore for 2%.
No,
so
or maybe
values the company at about 1,000 odd crores. We'll just try and pull that flash up once again. But it's a 2% stake, so I mean.
Or the larger idea is acquisitions taking place in the entire hospital space. I think that's where the trend lies. We just covered this a couple of days ago about how M&E is rising within the entire space.
Yes, consolidation in the hospital space as occupancies are rising, and occupancy is rising in the hospitality space as well. Indian Hotels is the other one, which is hitting a fresh record high in today's trading session, just as it has in the past.
Okay,
there we have 51.5 crores. And
it depends, if Medcare Hospitals, where it is, if it is possibly in the UAE, which is maybe their Gulf part of their operations, maybe the valuations would differ, but 2% for 51.5 crores is quite significant, you'd have to say. But they have been looking to grow their Gulf operations also.
Yes. Okay, we will monitor this as it goes along, but it's now time to take a short break, and on the other side we'll have a discussion lined up with Prashant Mehra of Grant Thornton.
Hello and welcome to the Deal Tracker segment of the show, and let me welcome on the show Prashant Mehra of Grant Thornton Bharat, who joins us live now. Prashant, always a pleasure speaking to you. Now, in the report that you have authored about the overall deal activity, it is the lowest that we are seeing in terms of the M&A in the last 22 months. And also the deal volumes as well as value have substantially declined in terms of private equity funding as well as M&A. How do you see the overall theme picking up at the moment? And also, is it a worry?
Hi, thank you for having me back again. Yes, all you mentioned is right, but I would say that is not something that is a surprise. Last month, we were speaking, we had envisaged this happening based on the deal activity for those few days, and now, of course, coming out for August as such. I think deal activity in August has shown us a mixed bag of emotions. On one side, we see that the deal activity has been the lowest since May of 21. And the volumes and values being half of what they were. But on the other end, we also see that, the M&A value from last month has actually doubled, especially if we compare it to the August of 21, the M&A value has doubled to what it was. Which is something that we always expected, because M&A will be driven by consolidation in the market.
Yes.
Some of the deals have been announced in the last couple of minutes on your channel as well. So all that is coming to light. The big gap that we see is really around private equity, which is also something that we were expecting. I think how this would really unfold in the next few months is private equities would probably shift their focus from going solo to actually backing large corporates in terms of consolidation financing, because we know acquisition financing is still not permitted in the country. So private equities will be looked at as an alternate means of financing, and they will not hesitate to finance the mature and large and complex companies in their consolidation efforts. Little activity should continue for the private equity in the next few months, I would say. But yes, probably around January or so, we may see things turning around if there are no surprises in the next few months.
So Prashant, a very interesting point you made. Private equity, instead of the way they were going into buyout kind of trajectory, are now looking at backing the corporates in consolidation as well as acquisitions. That also means that the big corporate houses are looking very acquisitive. What is the trend there? Which kind of companies, which sectors are seeing most amount of traction?
If we look at the last few months, energy / infrastructure, we've definitely seen consolidation there. We just heard about the healthcare transaction where there has been some consolidation. There are consolidations happening in the auto sector as well. And anything which is, I would say, complex and manufacturing as infrastructure, we would continue to see consolidations there. Hospitality is another sector which probably will see a lot of consolidation.
Right.
Also, just looking ahead, if I look at the 10 days or weeks of data for September, the trend is continuing. Private equities is half of what it was last year. M&A is still showing good traction. Last September, we did about $8 billion worth of deals. This year, it's already about $3 billion in the 10 days. The next few weeks would probably add another few billion to it. So similar trends are being seen in September as well, both from a private equity as well as a M&A perspective, and similar sectors are being tracked.
But Prashant, what private equity is more engrossed with is the exit opportunity which the equity market window is providing to them. Are there more to come? How do you see this? And also, given the equity market euphoria right now, against all the headwinds that we had been seeing in the macro space, well, how is the IPO market also looking?
I think the macroeconomic factors for India are there. There are some very strong companies with great business models, good revenue models. All boxes seem to be ticked. But I think the sentiment today is a bit subdued, which is why IPO activity will probably pick up January onwards. I personally do not envisage IPO activity in the next quarter or so.
Right.
January, yes, things should move forward. As long as the economic factors for India work well, and the growth forecast is not materially downward,
But we don't know about the macro headwinds at the moment, and also how the energy situation is going to pan out in Europe because of Ukraine. So market headwinds as well as macro data. One very quick question and very short answer expected. Will startup IPOs come back in the Jan window that you're talking about?
I think they will.
Okay.
I think they will.
All right. Many takeaways, Prashant.
Unicorns in the startups will surely will.
Okay, thank you so much, Prashant, for giving your views on the Deal Street action. Yes, there is a significant slowdown that is seen, but many M&A possibilities are also picking up along with consolidation. With that, it's a short break on the show. Get back for more action on the markets as well as news flow.
Welcome back. Well, the mid-cap seem to be faring better. So we have the mid-cap index up around 0.2%. Just watch out for a couple of these stocks, such as South India Bank. That stock is up around 16.5%. Good amount of volumes on that particular counter as well. And even something like a Muthoot Capital Services, which is around 249 rupees. That stock is up around 15% at this point in time. But those are a couple of gainers. Let's track a stock which has been sulking this entire week. Gland Pharma. It's down 2% today. It has corrected over 2% on a week-to-date basis at current reckoning as well. There seems to be concerns with regards to its parent company in terms of foreign media reports. Remember that overall the stock has also corrected over 40% from its 52-week high. So this particular correction that we've seen in the past couple of days is possibly linked to these reports. Now, regulators in China, as per foreign media reports, have asked banks, firms to check the financial exposure to Fosun. Regulators include the likes of China Bank and Insurance Regulatory Commission as well as the Shanghai Banking and Insurance Regulatory Commission. Now, the Fosun CFO has reportedly denied all of these reports and indicated that these reports are completely false. Remember, in the month of August, which is last month, Fosun was downgraded by the likes of Moody's by one notch to B1. So that's exactly where the concerns seem to be emerging from. There are concerns on liquidity, refinancing pressure, as well as exposure to the Chinese property market. Now, to give you a perspective, Fosun is a conglomerate, so it holds stakes in various businesses. This includes insurance, hospitals, diagnostics, fashion, entertainment. So it has exposure across sectors. Fosun holds around 57.87 in Gland Pharma. Now, remember that Forsen bought majority stake in 2017, which was 74%, for around 6,980 odd crores. And eventually, this particular stock was listed in November of 2020. Now, more on Gland because it has concerns of its own as well. Like I mentioned, it's corrected over 40% from its 52-week high. Q1 FY23 earnings disappointed for the company. Revenue was down 26%, margins disappointed, profit was down 25% as well. Now, the street fears there are near-term supply challenges which are sustaining into Q2. The company also, however, is confident in terms of margin improvement going forward. So let's see whether that comes through. Valuation-wise, trading at around 22 times in FY23 PE versus a peak of around 60 times. So that gives you a sense in terms of the kind of correction that we've seen. Time for a break now, but on the other side, Manisha Gupta, commodities editor, will be joining in with Kunal Shah of Nirmal Bang Commodities. Stay tuned.
Welcome back, and joining us on the show now is Kunal Shah of Nirmal Bang Commodities. Kunal, hi, as always, good to have you. And I want to start with the crude oil prices, where we are headed for a weekly gain this time around, at least what the numbers show until now in this week right now. If you look at the last 5 or 6 trading sessions, we are up by nearly 5.5%, holding around that $94 per barrel mark. What's your sense now coming in for the crude oil prices?
So the fundamentals of oil is definitely not looking very attractive considering what is going on with the financial monetary policy of the Western central banks. They are trying to deflate the asset prices, and oil is one of them. But at the same time, Russia is continuously reiterating that they may stop their supply to Europe if they put a price cap on oil. So it has become very uncertain right now. And over and above that, the Biden administration have mentioned that $80 they want to again refill their oil reserves. So combining all of these things, it seems that in short term we may edge higher towards $98 to $99 per barrel. But I'm still not very optimistic about the long-term outlook of oil. And looking at the weak demand growth and looking at the weak global economy, I think it will drift lower and again test $88.
All right. So you're giving us a range of 98 and then perhaps $88 on the lower side. But how would you react to the kind of surge up that we saw in the gas prices? 9% up for the US gas, trading at $9 right now. And the European Union gas prices also surged up by 7% overnight.
It seems natural gas seems to be the new nuclear bomb right now. The fundamental of gas is definitely not bearish at all. The fundamentals indicates and points out towards higher natural gas prices. Okay. But every time we see some news regarding some price cap or some of the other news, gas prices tends to go down. But my sense is that natural gas prices, looking at the winter season ahead in US and Europe, we are heading for the higher gas prices. Even if we like it or not, the gas prices are going to move up. And I'm expecting MCX natural gas prices to test levels of 750 to 770 going forward. And my view on natural gas continue to remain bullish.
Kunal, are you still bullish on the metal prices? You were initially, and then you were like, okay, maybe we've done a near-term peak here. What is your stance now? Because China seems to be opening up. US dollar is just about holding. Obviously, with the kind of views or the events that are slated out, you could be looking at some support coming back in case of dollar. But for many of these metals, with the energy concerns, the likes of aluminum and zinc, how will you trade them?
There are two factors deciding the outlook of metals. One is the monetary policy of the West, which is fundamentally bearish for metal prices, because the growth is going to slow down further. The housing and construction activity is going to slow down further. And another factor is China, which is the wild card. So 50% of the consumption of metals comes from China. And considering whatever they are doing right now, we are going to see some revival in the demand in next 1 or 2 months. So my sense is we are not going to witness a sharp crash in metal prices. But at the same time, because China is going to open up, and because the demand is going to revive over there, a minute upside is expected in near term. So it's always a mixed view right now in this kind of scenario. But the fundamental points towards no major upside, and we are going to see copper heading towards 620, 615 perhaps in later during this month, or maybe in October. Even aluminum is going to go down. So the fundamentals are not some small pullback can come, but the fundamentals points towards a bearish scenario.
So you're not buying anything at all in metals?
Well, I think it's a sell on rise opportunity. So being a fundamentalist, I would, and considering the macro environment, I would sell metals on rallies rather than buying them at dips and expecting it to go up. So copper around 660, 665 is a good short. And on the downside, I'm expecting it to go down to 625 to 630.
All right. Selling base metals on upticks, buying natural gas, and the crude oil price is also bearish. For the near term, though, you could be looking at some more upticks onto that one as well in the very near term. Kunal, thank you so much for joining us with all of those strategies. With that, it's a wrap on Halftime Report. But Business Lunch will take all the action ahead after this break.